Welcome to the Bulletproof Cashflow podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey everyone, this is Agostino. Executing the debt portion of your capital stack for the purchase or refi of existing multifamily or the construction of new development is important to your overall cash flow and returns. So finding the right financing partner is just as important as you scale your business. Well, today's guest is an expert at capital markets with tons of banking experience. He's negotiated debt and equity transactionally in various levels of real estate and different asset classes. He has more than 15 years of experience in commercial real estate and has closed and underwritten over $1 billion in transactions. He's the founder and CEO of Janover Ventures, a real estate advisory firm focused specifically on the capital markets. With all that, I'd like to welcome Blake Janover to the show. Hey man, thanks for coming on.
Thank you so much for having me. This is really something I'm excited about. I admire what you've done as well as your podcast, and I'm looking forward to the conversation.
Yeah, thanks, man. Thanks. But before we go on, if you like what Blake has to say, you can reach him via his website at multifamily.loans. Great domain name. And of course, if you like our content, please don't forget to leave a comment and rate the show. Okay, Blake, maybe go ahead and tell the listeners about how you got your start.
Gosh, that's a long story, and I want to be respectful of our listeners' time or your listeners' time. So I think an abridged version would be something to the tune of, I started as a residential mortgage brokerage business, probably in around 2003. In 2004, we became a direct lender and we started doing commercial direct lending, also specifically on multifamily. And since then, I've done work all around the world, had home bases in other countries, and have had a lot of adventures, but I'm still here, I'm still in it, and we're extremely active in multifamily finance, specifically senior debt, including the primary Fannie, Freddie, FHA, CMBS, and a little bit of structured, funky, creative debt products as well.
Excellent, excellent. So, like you just said, I know that you cut your teeth on the whole residential side of things, which I think is very much cookie cutter and very much, I guess you want to say, highly regulated by the government, right? As opposed to the commercial side, where there's a great deal more flexibility, right? So I know we're going to talk a little bit about Fannie, Freddie, and you already touched on it a little bit, but what are some of the bigger things that you see in terms of commercial lending versus residential lending, like some big differences between the two?
Well, gosh, I mean, proper commercial lending should be non-recourse with standard carve-outs, which means you shouldn't be signing personal guarantees. It's very well the opposite of residential real estate, which is one of the factors that accelerated the deceleration of our economy in the Great Recession was that everybody signed a personal guarantee and banks went after everybody's personal assets, and there was that kind of snowball effect. In commercial real estate, at least for underwriting debt, one of the big differences is that the loan should be made to a single asset entity, an SAE or an SPE, a special purpose entity, generally an LLC that only owns one property and borrows this money. And there's no recourse except for standard carve-outs, bad boy carve-outs, to the individuals that are signing for the debt. I think another important differentiator is in residential, one of the primary metrics was or is DTI, which is debt to income ratio. They're looking at your personal tax returns. They're looking at your W-2s. They're looking at your job history. And when it comes to proper commercial real estate underwriting, we're looking at the income the property's producing and how that relates to the debt payment. This is DSCR, an acronym for debt service coverage ratio. And again, lenders are more concerned with net worth and liquidity than they are with whatever shady stuff you're doing on your tax returns.
That's right. Now explain carve out. What does carve out mean? And the bad boy clause as well, which of course is when you're doing something bad, it's no longer non-recourse. But maybe go ahead and talk a little bit about some of those terms really quick.
Sure. So bad boy carve-outs, standard carve-outs, there's lots of names around it, but you can literally think about carving out a section of the loan docs that say that this loan is non-recourse except for in the case, carved out this component in the case that you've done some bad boy act. Bad boy acts are generally acts of fraud, tax evasion, things that are materially dishonest with really bad intent. Now, there's something to chew on, which is as you get bigger and you grow in the space and you start doing CMBS loans and other non-recourse loans, since many borrowers since the Great Recession have started to demand non-recourse debt, many lenders have evolved their standard carve-outs to have different triggers that actually can make non-recourse debt really full recourse, right? Like they'll throw things in there like submit quarterly financial statements to us no more than 10 days after the quarter's end. And if you miss that, they can just hold it in their pocket and make a loan non-recourse later. So if you're not able to negotiate some of these things out in a non-recourse CMBS loan or a non-recourse non-bank type institutional loan, then you do want to make sure that you know what all the rules are and you follow them carefully.
You know, I'll tell you what, Blake, it's funny that many newbies, what they'll say is, well, it's non-recourse, so who cares? I'm like, no, I promise you, if you stop paying that mortgage, non-recourse or full recourse, someone will be knocking on your door for their money. Guaranteed.
They'll find recourse.
They'll find it, yeah.
That's unfortunately the case. Look, the reality is that real non-recourse debt with carve-outs, if you follow the rules, you're going to be okay. But read everything. Don't hire the guy that you gave your traffic tickets to review your commercial real estate loan documents. This isn't a place where you want to save money. You want to hire experienced people. And I think that really goes for every level of this transaction, from the investment sales professional you're working with to your financial intermediary to your lender. It's good to negotiate with them, but don't work with somebody that's not an absolute pro when it comes time to buying like a piece of multifamily real estate.
Yeah. And part of it too is right from the onset is make sure you get into a good deal. I mean, don't go into it thinking that just because there's no recourse it means I can just start buying stuff. And it doesn't work that way. Still get into that good deal.
And it's hard to find good deals. And that comes with relationships, because if you're fiddling around on LoopNet and you find a bunch of good deals there, it's just because there's something that you're not seeing. I'd say like 9.5 out of 10 times.
Yep.
It's always good to follow the lead of experienced folks that you've gotten with references or from referrals or what have you. A lot of the cap rates you see online, for example, are almost always pro forma cap rates. Like, look at this 12 cap. And then you dig in and you're like, operating at a 1. How is this a 12?
Yeah. I often say that LoopNet is a place where deals go to die, right? That's what it is. I mean, LoopNet is really for finding brokers. That's what it's for. Brokers that are very active in this space will put their stuff on LoopNet, not because part of it is they want to market their stuff, but a big part of it is also to put their name out there, to put the brand out there. That's why they do it. So at least around here, that's what they do. So, well, good. Well, now, what are some of the options that multifamily borrowers have when they're getting and originating a loan? Like, what are some of the bigger options that they have?
Well, I think if we're talking about small loans between 1 million and 7 million, I think the best options are generally, and this is if you're buying stabilized product that you want to long-term hold, or at least hold for some period of time that doesn't involve substantial rehab. And I would say that the primary products are HUD 223F, Fannie, and Freddie. And Fannie, Freddie, this isn't just one loan product, right? So, for example, you could go to a lender because you don't want to work with a broker, and your lender could have a Freddie product. Well, Freddie SBL, which is now wearing the Optigo hat, has multiple products. And not all lenders have all the same Freddie products. And when it comes to Fannie and HUD, some lenders that do Fannie small have a minimum loan amount of 3 million. Others have a minimum loan amount of 1 million. Others have a minimum loan amount of 750,000. So a lot of these things are really worth considering. Many lenders won't do HUD 223F loans under $5 million or $3 million. Some lenders will do them down to $900,000. But anyway, I think the primary products are Fannie, which I think is particularly strong in secondary and tertiary markets when you want to lever up. Fannie Small also has an excellent self-amortizing product, a 30-year fixed and fully amortizing loan. Fannie rates should be coming down in October 1st, that's a long conversation that we could go that way if you want to. Optigo is really good in a primary market like think Manhattan, Miami, LA. But in these huge primary markets, there's great competition, right? Like the West Coast, Chase owns it. New York, You've got a few banks that really compete for the top and will offer similar products with lighter prepays. And finally, there's FHA 223F, which I think is a misunderstood or just unknown product for many folks. If you've got the bandwidth, the time to close, because closing is generally around 150 days, so it takes longer. It's not really the best product on the purchase unless you got a lot of room on the purchase contract. But HUD 223F has unbelievable market rate multifamily terms. So you're talking about 85% LTV, 35 years fixed and fully amortizing. When you consider MIP, which is mortgage insurance premium, and you factor that into the rates are still going to be 25, 50, maybe 70 basis points cheaper than Fannie or Freddie. They're a little more expensive to originate, but it's a great product. And Fannie, Freddie, and HUD, if you have something with some affordability component, like a LURA contract or what have you, they will all give you a little more leverage and a little bit of a better rate.
So the FHA 223F, does it make sense then to maybe do a bridge to get some sort of temporary financing, then get into it? Or like, is the rate that good? Is that product that good that makes it worth it? Because sometimes getting those bridges can be somewhat expensive, right?
Yeah. So one of the things you have to consider with bridge is the cost to originate and how much guaranteed interest there is. You know, a floating rate bridge loan that you could pay off anytime with no prepayment penalty is really not expensive, right? Because even if they're charging you 12%, if you're out of it in a month or 3 months, whatever, 90 days, it's a few points. If they have 12 months guaranteed interest, and that means you're paying 12 points no matter how long it takes. So that means if you pay off the loan in 3 months, that's 48% if you amortized. I mean, that would be a 48% APR. But yeah, it can be. I think we recently quoted a HUD deal at 3.2% with,
Wow.
I think it had I think it was green and had 25 bips of MIP. So I think the all-in rate was like 3.5%. Right now, there's a huge disparity between Fannie and Freddie and FHA because of when the government didn't raise caps for Fannie and Freddie, they got frozen up. And now their new caps, they're $100 billion caps for the 5 quarters starting Q4 this year, which is October 1st. They got $100 billion, 37.5% of that, which is allocated towards mission-driven products. So on October 1st, Fannie will start to get more competitive again. And then we'll see how they all shake out. But FHA is generally much more competitive because you've got government insurance on the debt. So it's much more attractive at the secondary market to buy. The short answer is HUD could be much better from a cash flow perspective, from a leverage perspective. 85%, 35 years fixed and fully amortizing, and super cheap. It's a great product to consider for any multifamily acquisition or refinance.
And that's awesome. And typically that stuff is also assumable, right? That type of debt is assumable?
All of it's assumable. Fannie, Freddie, CMBS, FHA, all that non-recourse stuff is assumable. The lenders don't want to get paid off.
Yep. Yeah. And that's the thing though, too. So, but the great thing about that, this 223F or any good financing solution that you put on a property is that down the road, when rates go up again, you still locked in that 3.2% interest rate. You can sell that. That's part of the package, right? It's, if today rates are at 6% and you have this asset at 3.2 and it's assumable, provided that buyer has the wherewithal and the ability to buy it and just take over the mortgage, assume it basically, that's a huge value add right there.
There's a tremendous amount of arbitrage that exists there, right? You get like a cap rate plus somebody can create positive leverage for themselves. So I think you said something that's really interesting that I feel like newer folks or people that weren't around for other cycles or perhaps haven't studied economics. Not that there's anything wrong with that, right? Like there's lots of things I haven't studied and lots of things I don't know. But on the short list of things I do know are economic cycles. And you said when rates go up again. And I think everybody just has to chew on the fact that rates will go up again and there will be a recession. I don't know when. I tried guessing a few years ago. I was wrong. I stopped guessing. I have no crystal ball, but I can tell you rates will go up again. There will be a recession. It might be in a few months. It might be in a few years. It could be in a decade. I really don't know what's happening right now. There's no precedent for where we are right now. This is a new thing, but we're not Australia running into like growth in perpetuity because like our treasury hasn't been a wonderful steward of the United States bank account, right? So rates will go up again. There will be a recession. Plan accordingly.
That's right. And the way you plan is to just start buying any good value property out there. I mean, that's how you do it. That's exactly how you do it.
And that transcends cycles, right? You always want to buy right no matter what. But now you can buy right, and you can buy right with like free debt. So do that. But be careful not to take a deal just because you have cheap debt and you want to get in a deal. You got to get the right deal. You got to buy right.
Yeah. Yeah. No, don't make that mistake out there, guys. Just don't make that mistake. So how about this? How about if someone who's never done a commercial loan before, what would you as a broker, what would you need to get started from them to get something rolling?
Well, we need the same thing on everything. So I'll run through it real quick, and then I'll talk about first timers.
Yeah.
So the basics are on a purchase or a refi, you want a T12, which is a trailing 12 month by month P&L broken down really well. You want a current rent roll. These are like the two key documents. For underwriting, the KPs, which is an acronym for key principles, you're going to want a PFS, which is, there's so many acronyms here, but I know that a lot of your listeners are newer investors, so I just kind of want to tell them what the acronyms are and spell it out for them. I feel like it'll be helpful. So you want a PFS, which is a personal financial statement, and generally an SREO, which is a schedule of real estate owned, detailing cash flow, contingent liabilities. Contingent liabilities are debt that you've personally guaranteed, credit cards, mortgages that you personally guaranteed, whatever. So that's the basics. And, maybe an org chart if you got a lot of partners, an organizational chart of the LLC. So that's underwriting the key principles, looking for round numbers, right? Like a net worth, a cumulative net worth greater than the loan amount, cumulative liquidity, rule of thumb, greater than 10% of the loan amount, post-closing on a purchase, pre-closing on a refi. For a purchase, give us an offering memorandum, a copy of the listing. For a refinance, tell us the original purchase date, purchase price, and a summary of your existing debt and your total cost basis. And a good reason for that cost basis is because leverage will sometimes be a derivative of loan to cost versus loan to value. So if you're refinancing a property and cashing out, the higher basis you can show, the more cash you're going to be able to get out, because you can show that you have like some level of remaining equity in the deal. If you're doing a refinance that happened, very soon after an acquisition. So those are basic documents off the top of my head for multifamily. And then speaking of first-time borrowers, there's some things to consider. If you're a student of Agostino's, I suggest that you tap them on the shoulder and ask them to join the GP as a experienced partner. To be serious, I do think it's really important to have an experienced partner if it's your first deal. If it's your first deal, you want to be close to the property. You want to be within, the rule of thumb with Fannie Freddie is 50 miles, but to me, you want to be within 10, 20 miles, and you want to hire a property manager that manages similar properties in that submarket. Submarkets are their own economies. If somebody is managing a bunch of properties in 3 neighborhoods down, that does not mean they're equipped to, and they may be, but it doesn't mean that they are equipped to run your property there. You want people with hyper local experience with the same asset class. So if we're doing multifamily, you want them to manage multifamily. It does not work when they manage 100, 200 single family residences and now they want to manage a multifamily building. It's not relevant experience. You might as well grab somebody that's managing retail. This experience does not transcend asset classes. Single family is a different asset class. And I say it because I've seen it in action many times, and I think it's an opportunity to help people not make a mistake before they make it.
Oh yeah, you're absolutely right. Because I actually have personal friends that some manage single families, some manage multifamily, 2 different ways, 2 different perspectives of even how to manage the actual asset, let alone how they run the financials on it. It's just 2 different things, 2 different animals. But to your point, when it comes to the partnership side of things, I absolutely agree. The only way or the best way is to partner on deals. It's not just these little deals that we're talking about here, or even a good mid-sized $20-30 million deal. Anyone in the real estate game doing 100, 200, 300 million plus deals all have partners. All of them do. They all syndicate. It's just what we do. We just do it on a much smaller scale.
They all raise LP, every single one of them. Nobody's going into a deal and cutting a check from his bank account for the whole thing. It's very rare. I don't want to say nobody, but most of it's syndicated LPs, all these big guys. It's all raised money. And there's very often co-GPs on the mega deals, and we see a lot of them. I probably shouldn't drop names, so I won't, but we see 100 million, 200 million, $300 million deals where there's multiple GPs. Other GPs are bought in to improve balance sheets. Some GPs are bought in to raise more LP. And then there's LPs, and the GPs are double dipping between the GP and the LP and the fees, but that's a story for another day. But the bottom line is that enlist the help of your peers and grow with the people around you. It's better to have a little less, especially of your first pie, and make sure that everything is kosher and good than to take an unnecessary risk. And we talked about it before. There's more on the line than just recourse, right? So even if your recourse doesn't get triggered, Fannie, Freddie, these lenders won't make a loan to you again if you default on one of them, right? It's like, can I give a totally unrelated anecdote? Can I do that?
Sure.
Totally unrelated.
Yeah.
So in 2008, when the world ended, I got eaten alive. I had to file bankruptcy. I was a young man. I was in my 20s. I thought I was so smart. We were doing tens of millions of whatever in business and blah, blah, blah. And I ended up going bankrupt. And this was more than 10 years ago, more than a decade ago. I put my business American Express card in my bankruptcy, and these guys still won't give me $1 of credit. So these creditors, remember, if you bought something up with Fannie multifamily, one of the biggest investors you could ever have, you're losing the people that are going to give you 80% of the capital stack for almost free. So choose carefully, bring in good partners, and always pay your American Express bill.
Well, that's actually a good segue for the next question, is that there's often this big emphasis about getting into Fannie Freddie debt right away on the first property. And I guess if you have a good partner, sometimes you can. But I mean, I've never seen a case where a brand new person or a group of them ever got directly into Fannie or Freddie on their first deal. Is that a thing? And how do you circumvent it if there is a way to do it?
So I talked about some of the ways to do it. So the best thing to do is if you have a partner where you can demonstrate that they've got a year of experience, at least in multifamily, even if they don't currently own multifamily, like if you do anything to tell the experience story. And this is like a little bit of a hack, but we've added property managers to the GP before, and that's gone well. Being really close to the property, having a super professional property manager. Fannie will overlook things if you have like a sick balance sheet, you got like a big net worth and liquidity. Sometimes you can get exceptions if you put more money down, you're not levering up 80%. And your first deal doesn't have to be Fannie. By the way, I think it's worth considering for loans over 2 million, that CMBS, there is no fixed net worth or liquidity or experience requirement. It's very, very asset based. You'll just take a bigger spread. So you could totally get non-recourse CMBS debt over $2 million if it's your first deal you've ever done, like 100%. They're very debt yield driven. I think another option is FHA doesn't have hard and fast rules about net worth and liquidity. And I think HUD 223F is a great option as well. So even if Fannie or Freddie isn't your first deal can still be a non-recourse 10-year fixed plus 30-year amortizing loan, cheaper than what your bank offers.
Nice. Good. So now, as far as options for deals under $1 million, here in Cleveland, for instance, you can still find once in a while a nice cash flowing asset, $600,000-$700,000, right? They're still out there for the time being anyway. What sort of recommendations do you have for those folks, aside from going to the local bank? Do you have any other ideas for them?
If they're going to go to a local bank, I suggest they go to a local credit union if they have that relationship. Credit unions, if you're physically close to the property and the property is physically close to them, you could expect a lower rate with less prepayment penalty and lower cost to originate. We have a partner that we work with for any deals under $1 million. They have a credit union platform where they do originations for, I think it's like 800 credit unions across the country. So we use a platform like that too. There's other stuff out there. For example, so you said a $600,000 deal, because I do want to say that we've done Fannie down to $750 and could do HUD a tiny bit lower, but it becomes very cost prohibitive from an origination perspective. So from a non-bank, non-credit union, there are a lot of lenders out there that do non-QM, small balance. They'll have features like 30-year amortization or lower documentation. Banks are going to look at your global cash flow. They're going to look at your personal tax returns. They're going to look at your W-2s. And there's some lenders that'll overlook that, but you're going to pay the price. The ones that come to the top of my head are Silverhill. They're a great shop. Love them. I've done a bunch of stuff with them. I've got buddies over there, but there's a lot of guys out there in that space. Off the top of my head, maybe like Velocity, KCMI, Cherrywood was like they closed and they reopened and now they're getting competitive again. ReadyCap has an unbelievable product. If you could fit in it, they've got a great fixed rate product that's a wonderful CMBS alternative and works for under $2 million, works for under $1 million. So there's a lot of options out there. I think I'm not going to be self-promotional. I'm going to say get a referral to a really experienced financial intermediary that will either arrange the debt for you or like be super friendly and point you in the right direction. We do a lot of that, right? Like, hey, this isn't a fit, but I think you should talk to this dude, or I think you should talk to that dude. And, we're not going to charge you anything, but when you grow and get bigger, come back to us and give us a shot at it. And actually, we did a small loan, I don't remember what it was, but for one of your guests, and he did come back later for a bigger one. And he actually ended up giving it to the local guys. It happens, but I think it's important to know that there's a lot more options than strolling into your local bank. And it's important to know them. You have a fiduciary responsibility to the LPs that you're raising money from, and you have a responsibility to yourself to make sure that whatever deals you're investing in and whatever financial activities you're engaging in, that you are maximizing your reward and minimizing your risk.
Right. Well, it's one thing you just mentioned too, that the intermediary, that the financial broker. Keep in mind, guys, they are a partner. They are part of your team. And to find a good one, it's one of those things you have to do. They must be good at what they do and not mess up the deal, which is doable for someone like that to mess up the deal. The intermediary can bring the wrong lender to the table, lock up the financing period. Then you get to the end of the financing period, then the lender will come back and say, sorry, we can't do this loan. We don't like that specific asset class or whatever the case may be. And not to mention too, if that does happen, that intermediary will find the right solution for you, as opposed to if you did go to a bank directly and they do the same thing to you, you'd be hosed.
Right.
You basically have to go start the process all over again, which you don't want to do. You don't want to do that.
You're 100% correct. I feel bad saying this, but I have to watch out for residential brokers that are trying to get into commercial. Watch out for that. Some other things to watch out for. Watch out for term sheets or LOIs that ask for large deposits without doing any due diligence, or that you can't find due diligence from them online. So everybody is going to require a deposit. Nobody's going to sign you up and then pay for the appraisal and pay for the environmental study and pay for the PCA and pay for legal. And then because we see that sometimes, right? Where we send out an application like, okay, we're ready to go. And by the way, our close rate's like 98% on applications. It's something crazy. We send an application and it requires like $10,000, $15,000. And they're like, I'm not going to do that. My bank wants $3,000. Well, I mean, there's a big spread between us and the bank, but there's no lender that's going to shoulder those economic risks or costs, while you figure out if you want to do the deal or not. Now, at the same time, in the last cycle, there were lenders out there, some guys went to prison for this. I think it was the folks at Remington Financial. They were just putting fees and sending term sheets to everybody. So do your due diligence on your broker, your financial intermediary. If you can get a reference, that's great. Like if you have a buddy that he closed a loan for and he's like a good dude, and like you can talk to another multifamily investor who's like, yeah, I had a good experience with this guy, that's priceless. And by the way, another thing about intermediaries is if this intermediary is worth his salt, he will not cost you anything. Like we don't charge any fees on Fannie, Freddie, FHA, CMBS. Our lenders make less money and we just provide more volume, and that's it. A good intermediary isn't going to cost you anything. I'm trying to think what other warning signs to watch out for. Well, there's a lot when you're buying the property, but Agostino, I think that's more your universe. So I would just say from an underwriting perspective, if you're looking at a purchase, always underwrite whatever the worst case scenario real estate tax number is going to be, because that's going to be the number that's used to underwrite the NOI, which is the net operating income, which is going to be used to determine the debt service coverage ratio, which is ultimately going to determine your loan proceeds and your actual cap rate. Because if somebody bought a property in 1920, whatever, for $100 and they're not paying any real estate taxes on it now, when you buy it for $3 million, you're going to be paying real estate taxes on it. And that's going to hit your NOI right where it hurts.
That's right. That's right. And by the way, those financial intermediaries, they charge 1%. I've seen that's the norm around here anyway, but it could be more in some other markets.
We don't.
Right. If you don't, then that's good. That's good. That's why I'm pointing that out. Because
Thank you.
don't let anybody else, first of all, tell you anything different. So now, and we touched on this earlier about bridge loans for using that to get into a deal. And since you have a 98% close rate, that's awesome. But in the event that, let's say, for instance, someone used one of these intermediaries that aren't so hot, then you're suddenly now forced to use a bridge that may not have the best rate. So what are some of the considerations around doing that?
I want to qualify a few things. I think we have a 98% close rate on Fannie Mae loans that we've apped. You know, CMBS, Freddie, Bridge, like everything varies a little bit, and that's after we've apped it. Also, for fees, we don't charge a fee for Fannie, Freddie, CMBS, or HUD, FHA, but we do on Bridge, at bank, and institutional balance sheet type debt. So going to Bridge, so you hired a financial intermediary or a commercial mortgage broker, and you screwed the deal up, and now you gotta go and get a bridge loan. Some bridge is good, some bridge is bad. I think there's a lot of great bridge lenders out there that lend really competitively priced. If rates are higher, it's just because we've been in this weird environment where the yield curve is inverted from time to time. But there's some unbelievable bridge to agency lenders out there. Most of the agency lenders offer a bridge to agency product, which is usually used to take a product, maybe from like 70% occupancy to 90% occupancy, or to do some rehab work and, maybe separately meter everything. So there's some great lenders out there for that, but they take the same amount of time as anybody else to close. They're generally going to take 45 days, like best case 30, worst case 60. When you start getting into a time crunch, there's more expensive lenders. And I guess I'd put them into two buckets. I'd put them into the bucket of like exploiting you, loan to own, super high interest rates, like tough dudes, and then like guys that are doing a good job. And it depends on loan size, asset class, like MSA, specifically where the property is. But I can run off a list of a bunch of wonderful lenders that won't just try to kill you on the bridge. And I think at the end of the day, it's also something that boils down to either having all those relationships yourself or knowing somebody that has those relationships. Things to watch out for on the bridge side: over promising and under delivering. We'll close in a week is generally a lie. If you have like a super full package, I mean super full, like third party reports ready to assign, appraisal, PCA, environmental, that the existing lender is willing to assign all of those to somebody. You've got title finished. I mean, it's happened. We've done it before. I've closed a loan in 5 days, but I mean, you're talking about 2 or 3 times in a decade and a half. But there are some good bridge lenders out there. Who comes to mind? Trez, Money 360, Bloomfield. There's some good guys, but everybody's in business. So cross your T's, dot your I's, and try to get it right the first time. Try not to get into a scenario where you need bridge to fix something that you screwed up. The right kind of bridge is good bridge, which is the bridge for, this is a value add acquisition. We're gonna improve income, reduce expenses, amenitize the property a little bit, fix up the parking lot, whatever. And then this is going to be so sexy for a Fannie, Freddie, CMBS, FHA loan later. And we're going to refinance, cash out, recapitalize, and put perm debt on it. There's a lot of wonderful bridge out there for that.
Yep. Yeah. Well, and that's the thing though, too, is that your bank, like I said, your bank is your partner and you have to give them the complete lowdown of what the play is with that property. If you're doing a value add, it's at 70% occupancy. You hand over all the T12, you hand over all the financial information, and you work together to figure out what the strategy is to get to, first off, acquire, and then secondly, move it into a Fannie Freddie solution or something like that. But sometimes people have this, I don't know why, this negative type of scenario. Oh my God, the bank's out to get me. And it's totally not the case. The bank is your heaviest investor in the asset. They want to make sure that there's a plan in place and whatever that plan is going to be followed. I mean, to me, it makes total sense.
Of course, yeah. Think about Fannie and Freddie. They don't get to go after you if something goes wrong. They don't want to own this property. They are betting on you. They're underwriting to make sure that this is a good deal. And by the way, if you're not hard on your purchase contract and Fannie and Freddie underwrite it and they're like, no, then consider why. And then maybe it's a bridge to Fannie situation or a bridge to bank situation. But Agostino, I think you mentioned something really interesting, and it's important not to keep secrets, right? Like, these skeletons come out every time. they would come out. If I was hiding something, if Agostino was hiding something, if you're hiding something, you're talking about a multi-trillion, you're talking about an industry worth trillions of dollars with trillions and trillions of dollars in historic back record and data that they're pulling on. They know what underwriting is. They know where the secrets are. It's all going to come out. It's going to come out in the appraisal. It's going to come out in the PCA. It's going to come out in title. It's going to come out in legal. It's going to come out in background checks. Everything's going to come out. Just disclose it all up front and give a thoughtful, honest explanation for whatever there is and get ahead of it. Because 3 weeks into the deal, it's all coming out. Everybody's going to find it.
Right. When you have that, you want to know during due diligence and you have no money that's gone hard yet, you want to know that you're going to get this deal done. You don't want to wait a month and then figure out, oh yeah, by the way, we're not doing the deal because we found that you have XYZ in your background and we don't like that or whatever.
Right.
Yeah.
Oh yeah. Listen, I had a bankruptcy in 2008. It is what it is. I mean, the world ended. I can give a really good story about it, and I'm pretty financeable. Not to American Express, but be forthcoming. And also, you don't want your own. I mean, you could do your own inspection, but you want the lender ordered PCA. We had a deal recently, or not recently, it was some time ago, where the lender uncovered these foundation problems that nobody would have found, and the building would tip over one day. And we've had environmental reports turn up some really scary stuff that have gotten buyers out of contracts. And it's important not to just disclose, but to use the due diligence period, not to expedite a closing, but to really do due diligence and make your best efforts to uncover whatever treasure or horror stories or skeletons may be buried.
That's right.
In the property.
That's right. Well, yeah, and as part of your own due diligence, which we won't get into today, but make sure you have an inspection every single time. I do a complete inspection on all my assets. Every single unit is inspected.
Heck yeah.
Before we buy it, and then even after, just before closing, to make sure the asset is still in good condition. I walk through it with a manager to make sure that it is what we're getting, right? Nothing has changed, which has happened, by the way. This has happened.
If you give the seller if you're like, hey, seller, open up a few units, they're going to open up the granite countertops and the stainless steel sinks. They're not going to open up the mold and the little things that look like ants that eat the wood.
Oh, termites.
Yeah.
Yeah, especially in Florida. Yeah.
Right. Well, termites and mold. That's what we got.
That's right. So now, as far as the outlook for multifamily, we touched on recession a little bit. What are your general thoughts? What is your crystal ball six? I heard you have one on order or something like that. Or anything might have just arrived. I'm not sure. But what are your general thoughts about recession?
I think I could say with absolute confidence that my predictions aren't worth anything. But I'll play the game. So I think from a macroeconomic perspective, there's these two kind of parallel schools of thought. There is a continuing demand for multifamily. There is a shortage of supply of particularly really of affordable multifamily. People need places to live. And there's also this, what we talked about, which is that a recession is coming. So what does it mean for multifamily? Well, if I had to hypothesize, which is what you're requiring I do, I would say that multifamily is an asset class that's historically extremely resilient. I think that these issues become very, let's say, microeconomic. So I think you're going to see impact on specific MSAs, towns, cities, and classes. So what you may find is that in the face of a recession, for example, people may sell their homes or may move out of their Class A multifamily, let's say in San Francisco, and move to a secondary or tertiary market, either because they're knowledge workers and they can work remotely, or they're willing to commute and they can get better amenities, more size at a better price. So I think a recession could actually create positive economic drivers in secondary and tertiary markets that are experiencing job growth, that are experiencing population growth already. I think that's something that can happen. I think as the economy slows, something that's not often talked about is, even though there's a need for highly amenitized Class A multifamily, the rents can only go up as it's supported by the income of the individual or the family that's renting the unit. So at a certain point, rents can't continue to go up. and pro formas are going to have to be recalculated because, even though that people underwrite for inflation on rent growth, if income's not going up 2 or 3% a year, neither is rent. So I think you're going to see people moving out of Class A, and then Class A's response is probably going to be concessions and ultimately lower rents. I don't know how far it goes. I've lived through the worst of it, right? Which happened in the last cycle. So I guess like the reverse of that would be that everybody moves out of their Class A multifamily and then that market collapses and then people buy it cheap and convert it to condo. I don't know. I'm definitely not saying that that's going to happen. I guess if I had to, you asked me for something and I said, I don't know. And then I just started talking. So I guess if I had to make an educated guess, it would be that in the face of a recession, I think you could actually see positive impact to secondary and tertiary markets as people look to improve the affordability of their lifestyles. And you'll see people move out from maybe Miami to Broward or from Broward to Orlando, things like that in Florida. I think we're in a business with a very resilient asset class that is very microeconomic in nature. Oversupply in a neighborhood can really damage that neighborhood, but it may have no impact on the neighborhoods next door. So when you're considering a recession in the future, really look at the town that you're investing in and take a more microeconomic approach.
Yeah, nice. So now what do the next 5 years look like for your business?
We're going to be the biggest multifamily financial intermediary in the country. Watch out, Meridian. Watch out, Eastern Union. Coming for you.
Awesome. All right, guys. Well, if you want to reach out to Blake, you can reach him via his website at multifamily.loans. Thanks for your time, man. Greatly appreciate it.
This was so much fun, dude. Thank you so much for having me. I hope you'll have me on again someday.
Oh, yeah. No, we'll be on again. Thanks so much, man.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast. For more free podcasts, articles, videos, and resources, go to www.bulletproofcashflow.com.